Hello and welcome back to Sam's Finance, where I talk about personal finance, companies and their stocks. Topic of today's video is Bitcoin. If you don't have a clue yet on what Bitcoin, this legendary internet money is, then I recommend you my introduction video about Bitcoin that I will link in the description. But now let's get right to the topic. What's in store for Bitcoin in 2021? Let's first see what the professionals are saying. This news right here broke about 2 weeks ago and created stir. A senior analyst of Citibank, a great American or big American bank, came out and said Bitcoin could pass 300k USD by December 2021. Now, at the time of this video, the price of Bitcoin is sitting at about 19k per Bitcoin. That translates into a 15x price increase from here based on this, let's call it analysis. If you are like me, I now question myself, how do they come up with this number? Because no matter how tempting the forecasts may be, as in this case, nobody has a crystal ball, not even Citibank. These predictions are almost exclusively based on technical analysis, and this news is no exception to that. Let's now quickly visit the mother of all technical analysis charts for Bitcoin in 2021, the rainbow chart. This chart plots the Bitcoin price in a logarithmic scale, what makes it easier for the human brain to understand, or rather to extrapolate, exponential charts into the future. Then you also see the halvings marked. A halving is an event firmly anchored in the code of the Bitcoin blockchain that occurs roughly every 4 years, or actually it occurs every 210,000 blocks. It means that the block reward for newly mined blocks gets cut in half. You can basically understand newly mined Bitcoin blocks as Bitcoin's inflation. So the easy way to understand the halving fundamentally is to say that Bitcoin's inflation gets cut in half. And that, at least in some way, reduces Bitcoin's supply on the market. If now demand would stay the same, the price would have to move up slightly, just on a very basic level. The main story that this rainbow chart tells, however, is the following. Historically, Bitcoin has started a new bull run, or bubble as some say, about 6 months after both of the two halvings. The guesswork, therefore, is that the economic implications of every halving cause some kind of a chain reaction. You can see on this slide I made my own technical analysis, or what I call it, coffee cup reading. I took the time frames between the two previous halvings and the respective peaks of their bull markets. Then I thought, it looks like the time frame between the halvings and the peaks are getting slightly longer. Let's also continue this trend and extrapolate this into the future for the third halving. Voila, my prediction is 180k by December 2021. Except that I am joking, so please do not quote me on that. This was just to show you in a nutshell how people and analysts come up with these price targets. I want to show you one more model that is popular in the crypto space for trying to gauge value. And this one might be one of the better ones because it at least seems to have a scientific foundation. I'm talking about Bitcoin's stock-to-flow model. Stock-to-flow models generally are not limited to Bitcoin and have been in use for precious metals like gold before. The key concept that this model is built on is scarcity. In short, the stock-to-flow model compares the stock, the amount currently in reserves, to the flow, the amount mined each year. You then divide the stock by the flow. One quick example. Let's say the amount of a commodity in stock is 10 units and 2 units are additionally mined each year. In this case, one would divide the 10 by the 2 and get a stock to flow ratio of 5. And if this same commodity now would have a flow of only 1 new unit per year, then the stock to flow ratio would be 10. And 10 is greater than 5. The stock to flow model now claims that the market cap corresponds to the stock to flow ratio, or in simpler words, the lower the inflation rate of a commodity, the more precious it is. That's the stock to flow model in a nutshell. However, this is not a law of nature, but only the thesis that the stock to flow model puts forward. If you were paying attention, then you have realized that the stock to flow model is again tied to the Bitcoin halvings, which actually cut in half the flow part of the equation. That's how Bitcoin went from a stock to flow ratio of about 25 before the halving in May 2020 to a sudden ratio of 56 now, making the jump from silver's ratio to the ratio in the region of gold. The market value, however, has not caught up yet and still sits at a little more than silver's market cap of 300 billion. Compared to gold, Bitcoin currently only sits at around 4% of its market cap. And this is how the stock to flow model establishes a huge upside for Bitcoin, because according to this model, Bitcoin would be in for a 15 to 20 fold. One general note here at the end of the stock to flow model: we know the exact market cap of Bitcoin because we exactly know how many Bitcoins have ever been mined and even will ever be mined. However, on the side of gold or silver, we don't know how much has ever been mined, and we can only estimate how much is still out there. Therefore, the market cap of traditional commodities can only be estimated. And while we're at it, the flow of normal commodities can be adjusted and possibly also increased. Bitcoin's flow, on the other side, is algorithmically defined and will only decrease from here with the next halvings until the 21st million Bitcoin is mined in about 2140. Okay, so now enough of scientific or not so scientific models. What do I think? Well, let's zoom out on the last 4 years. In September 2017, the whole crypto space saw this incredible hype up to just below 20k, and soon after a huge correction of up to 85% down to a little over 3,000 USD in late 2018. Then we saw a rebuilding in the first half of 2019, and after that basically stagnation, a COVID-19 flash crash in March 2020, followed by a quick recovery, and then it seems like the rocket has taken off again this October. This puts us now in the situation of battling for the all-time high at 20k. That begs the question: are we in for another giant sell-off, or is this situation different now? I believe this time is different. In 2017, the hype primarily brought retail investors into the market, and to be honest, I was one of them back then. However, as soon as the prices tumbled, most of the mainstream interest tumbled too. And this fact is still true currently. We only see 1/5 of the research queries from 2017, even though we are at the same price levels again. What can be concluded from this is that the rally so far was not driven by the crowd, but by fewer people investing larger sums. I would also like to mention that whenever we look at the price increase of anything, it can be either because the good has gained more value, or the currency we measure this good in has lost value. How can a currency lose value? Through inflation. What causes inflation? It is generally believed that an excessive growth in money supply causes inflation. And this is exactly what we have seen in 2020 as a response to the economic fallout of COVID-19. Here we are looking at the US dollar M1 money supply. That includes funds that are readily accessible for spending. Heading into 2020, this money supply was sitting at 4 trillion USD. Now, 12 months later, we are sitting at 6.2 trillion. The M1 USD money supply has therefore increased by 55% in just the last 12 months. And even though the Federal Reserve has been constantly printing money ever since the financial crisis, these amounts are unprecedented. One can also see some implications of that if we look at the US dollar compared to the euro. In 2020, the dollar has lost about 10% against the euro, and the European Central Bank has been printing money this year too, of course, however less excessively than the Federal Reserve. This currency dilution went to fund the $1,200 stimulus checks in April, for example. There is a website that tracks how much this stimulus check is worth now if you had converted it into the harder money, Bitcoin. I find this interesting for its strong symbolicism. However, it cannot be seen as a real-time ticker of the US dollar's dilution, in my opinion. Okay, economics excursion ticked off. Let's get back to my opinion that Bitcoin's rally so far was driven by fewer people investing larger sums instead of the big crowd. In the second half of 2020, a bunch of publicly traded companies started to convert some of their cash reserves into Bitcoin. And because they are publicly traded, we also know how much. If you are like me, you are now looking at these logos thinking, I maybe know one or two of these companies. Square is probably the best known company here, known for its Cash App in the US. MicroStrategy is a non-fintech company that was an ordinary S&P 600 company developing business intelligence software until the founder, Michael Saylor, decided to convert the company's 250 million cash stockpile into Bitcoin last August, which turned out to be perfect timing because they bought in for around 11K. Then there are names like Galaxy Digital or Grayscale that see themselves as the bridge between crypto and the institutional world. All the companies on this slide and a handful more together own more than 4% of all Bitcoins. Also noteworthy, nearly all of this 4% share was bought in 2020. I don't really know what to make of all this. I'm a little clueless because on the one hand, I see little known companies and so no big names, and on the other hand, even they managed to buy 4% of all Bitcoins in 2020. And for some of these bridge companies like Grayscale, I don't know which big names maybe are making use of their Bitcoin investment trust. So some more easy to understand bullish news from the last couple of months. In 2017, JP Morgan Chase CEO Jamie Dimon famously said that Bitcoin is a fraud worse than the tulip bulbs and that he would fire any of his traders in a second if they were trading crypto. Then 2 years later, in 2019, JP Morgan Chase created their own JPM coin for internal use. In October 2020, JPM's own analysts now say that Bitcoin could be in for quite a big upside, and in mid-November, Jamie Dimon acknowledged that some very smart people are investing in Bitcoin these days. Yeah, and actually I could not have put it better to summarize my impression of the current situation. And then on October the 26th, news broke that PayPal will be offering to buy, sell, hold, and shop with cryptocurrencies in its app, allowing it to easily spend cryptocurrencies in its network of 26 million retailers. Now, getting to the end of this video, you might still be asking for my outlook. The way I see it is that gold is valuable today. But why actually is that? It's only got very limited industrial use, especially compared to other metals. And when a famine breaks out, you cannot eat it to survive. My reason number one, gold is scarce. And we already talked about that at the stock to flow model. I believe this scarcity is important because if you look at all the things that have ever functioned as money, like shells, salt, or cigarettes, and they were all scarce or difficult to obtain. However, I don't think that scarcity is enough. It has to be transportable, durable, and divisible. But Bitcoin does all these 4 points, including scarcity, better than gold in my opinion. Ultimately, any currency or store of value needs human trust. And this trust is built through branding and most notably, time. Every day that Bitcoin's blockchain is up and running, people will subconsciously accept its presence more and eventually gain trust. Look at all the tulip bubble comparisons and the going to zero talks of 2017. The tulip bubble never formed a second all-time high. I kind of see all the price prediction theories as potentially self-fulfilling prophecies because they awaken the faith in people. And the unique thing with a store of value is that just this belief of more and more people, in fact, makes it more valuable. And this is also a big difference to stocks. With stocks, there will come an earnings day where the company will have to let its pants down. If this makes sense to you, then why should Bitcoin not be able to reach 20 or maybe even 50% of gold's market cap? Remember, we are sitting at about 4% now. What would such numbers mean for the price? You can figure out yourself now. Disclaimer, for Bitcoin, it is easier to lose all its trust compared to gold. I cannot see how gold's trust would vanish within days. However, with Bitcoin, this could happen almost instantly with a bug in the code, for example. But in the end, this is the risk and the price you always have to pay for tremendous upside. If it is worth it, you have to work out that for yourself. I hope I could provide you with some assistance on both sides. And with that said, thank you for watching. You can help me out by subscribing to my channel and remember, just be lekker. Bye bye.